Good morning and welcome. What a great day. We've had a wonderful autumn season, beautiful colors, and hopefully we'll make your taxes fall like the leaves are falling right now. The colors aren't quite as spectacular on your tax returns as they are on the leaves, but we'll get started. For those of you that haven't yet had a chance to meet my wonderful associate, Chelsea Chartman, she is co-hosting this with me, and if everything goes well, it's probably all her doing, and if there's a slip up, that's probably my fault. So we're going to talk about some year-end tax tips. We'll start that again. Well, we're going to work out some year-end tax tips and tricks, all fully legal, so they're not that kind of tricks. We don't want anybody going to jail over this, but there are some things you can do before year-end to try and minimize the tax impact that you'll see on your tax returns next spring. So I'm going to turn it over to Chelsea for some housekeeping rules.
Thanks, Derek. Yeah, I guess the name is a little bit of a tongue twister, but we'll forgive you this time. Just don't let it happen again. Yeah, so I think I've met most of you, but I just wanted to give just a brief introduction. So I've been working with Derek since February as his associate advisor. But I've been with Asante actually since 2015, so I'm very familiar with how Asante works. So without further ado, I'm just going to do a couple little housekeeping items before we start. So you're currently muted and your cameras are off. If you could please keep them that way. We have also set aside about 10 to 15 minutes at the end for questions. In order to submit your questions, you'll be using the chat function on Zoom. So just send your question via chat and we will get to those at the end. I also have to read this disclaimer, so just bear with me a minute or two while I read through. This material is provided for general information and should not be considered individual investment, tax, accounting, or legal advice, or construed as an offer or solicitation to buy or sell securities. The statements and opinions expressed are those of the presenters and not necessarily those of Asante Financial Management. All opinions expressed and information provided herein are subject to change without notice. Every effort has been made to compile this material from reliable sources, as the date indicated. However, no warranty can be made as to its accuracy or completeness. Market conditions may change, which may impact the information contained herein. All charts and illustrations in this document are for illustrative purposes only, and they are not intended to predict or project investment results. In considering any particular investment or investment strategy, please remember that past performance is no guarantee of future performance. The information contained herein may not apply to all types of investors. Before acting on the information presented, please seek professional financial advice based on your personal circumstances. All right, so now that we've got that out of the way, we'll just briefly walk through the agenda. So we're going to talk about Canada's tax system and how it works specifically in Ontario. We will then walk through various tax planning strategies and finish off with our personalized year-end tax optimization process. Now, Derek, why don't you start off with Canada's tax system?
All right, Canada's tax system is what's known as a progressive tax system. So it started out, as many of you might know, as a voluntary system back to support the First World War. But as you know, with the government, it seems once they start something, even if it appears to be for a temporary thing, it seems to get embedded and last forever. So we have what we call a progressive tax system, and that simply means the more money you make, the more tax you pay. The tax system is divided up into brackets. So as you hit certain tax brackets, you'll start to pay an even higher percentage of tax on that income, sort of represented by here. If you earn a little bit of money on the left side of the screen, then you don't pay a lot of tax. By the time you get to the right side of the screen and are making lots of money, you are paying a much higher rate of tax. There's a federal rate, which applies to right across Canada, and then each province has its own rate. So then you pay a combined rate on tax. All right, that's
Right, good. Thanks, Derek. So we're just going to go through the basic formula on how your taxes are calculated. So there's four main categories when you're looking at your taxes. there's total income, net income, taxable income, and tax payable. So, and how we get to the tax payable line, we start with net income. So you take all of your total income from all your sources, subtract any deductions that you might have. So this could be things like RSP contributions, carrying charges, or pension split amounts. And then to get to your taxable income, there are additional deductions, which are then taken off of your net income. So these could be deductions like capital gains deductions. And then finally, to reach your tax payable, you multiply your taxable income by your average tax rate. Derek is going to go into tax rates on the next slide, and we'll get into more detail on what these terms mean and how this formula works. But let's get into some tax rate information.
All right, so we will go through and we'll actually put some numbers to these things so it makes a little more sense, because just talking about it and seeing words there. So marginal tax rate means the amount of tax you're going to pay on the next dollar that you earn. So if you're in a 20% tax bracket, you're going to pay 20 cents out of that next dollar that you earn if you're working overtime or whatever. Your average tax rate is how much you pay when you average out the tax over your entire taxable income. So to look at a graphical example, you can see the dotted blue line shows the marginal tax rate, where you're starting to pay a higher percentage of that next dollar of income earned, whereas the red line shows your average tax rate. So you can have a very high marginal tax rate, but your average tax rate will be much lower than that, because it averages out all the different tax rates that you've used. Okay, and so as I mentioned, there's each province has its own brackets or its own set of rates. Most of us are in Ontario, so it shows rates here. The Ontario rate, based up to $46,000, is the lowest rate. For the federal government, up to about $50,000 is the lowest tax rate. And then you can see that it goes on from there and becomes higher and higher until you get into very high incomes and very high tax brackets. In addition, it's not as simple as just adding the two together. In many cases, there are some surtaxes, or in Ontario, there's an Ontario health tax that gets added on as well. So your marginal tax bracket is usually a little bit higher than the combination of those two simple numbers added together. So carry on, Chelsea.
Okay, so we'll just walk through an example. As you know, all those brackets and numbers and percentages seem a little complicated. So let's bring in Brian, who is 35. He's single and makes $50,000. So if we look at his $50,000 and how it's broken up per bracket, so you can see the dollar amount brackets on the left and then the tax rates per bracket on the right. Then we get into breaking it down by dollar value of how much of Brian's income is within each bracket. We then multiply the dollar value of income by the tax rate, and we receive Brian's total tax payable. So you can see at the bottom, his tax payable is about $7,500. Now, the actual tax he would end up having to pay would also be based on tax deductions and credits, but this is just based on, his income multiplied by the tax rates. So now we get into what's his marginal tax rate and what's his average tax rate. So you can see here that Brian's marginal tax rate is just over 24%, and this is on every dollar that's earned over and above. His average tax rate is just under 15%. So as Derek was saying earlier, marginal tax rates are typically higher, and then the average tax rate is typically lower. Now, there's a number of ways that you can minimize your taxes. The most common method is by using tax deductions, which Derek will go into next.
Alrighty, tax deductions. Everybody loves tax deductions because it reduces your taxable income. That's the main purpose. So that means you don't have to pay tax on that amount of money that you were able to deduct. So tax savings are based on your marginal rate, as we talked about. So the higher your income, the more tax savings. If you're in a 20% tax bracket and you get a deduction, you only get a 20% tax saving. But if you're in a 40% tax bracket and you get a deduction, you get a 40% savings on that. So the most common examples, RSP contributions. You put $1,000 into your RSP, you get back your marginal tax bracket. If you're in a 20% tax bracket, you only save 20%. If you're in a 40% tax bracket, you save 40% of that. If you're part of a pension plan at work, those registered pension plan contributions also reduce your taxable income. There are certain childcare expenses. If you have a rental property or you've borrowed money to invest in a taxable account, the interest expense on that investment becomes a tax deduction as well. So let's look at the example again now using an RSP. Here's Brian. He makes $50,000 a year, but he makes a $1,000 RSP contribution. So now he only owes tax on $49,000. His marginal tax rate, as we saw, was 24%, 24.15. So he reduces his tax a little bit. He's going to get a little bit of a refund, exactly equal to his marginal tax bracket. Surprise, just do the math. 1,000 times 24.15, he saves $241, almost $250 in tax savings. So that's Brian, but Chelsea's going to take a look at, this is actually Chelsea, but we renamed it just to keep things simple. We renamed it Carrie.
Carrie, yeah, I wish I made $125,000, but that's going to happen very soon. So we have Carrie here. She makes $125,000. Her marginal tax rate is higher than Brian's. So when she makes $1,000 contribution to her RSP, she actually saves $434, whereas Brian only saved $241. Now on the surface, this may not seem fair because higher income individuals actually benefit more from tax deductions. So that's why the government has implemented tax credits. And Derek will go into this a little bit further.
So tax credits were introduced to try and level the playing field a little bit and treat everybody the same when it comes to tax savings or tax. So tax credits don't reduce your taxable income as deductions do. They reduce the actual tax amount that you owe. So they reduce your tax payable. So tax savings are based on the lowest federal or provincial rate, not the marginal rate. They're always based, it doesn't matter what the credit is, it's always calculated at the lowest rate. So everybody, whether you're in the 20% tax bracket or the 50% tax bracket, your tax credit is exactly the same. Then there are refundable and non-refundable tax credits. So non-refundable tax credits are things like your basic personal exemption. Everybody can earn a little over $14,000 and pay no tax. But why they're non-refundable is if you didn't owe any tax, they're not going to send you a check. Same thing with the age credit. For those of you that have had the magical birthday of 65, there's another approximately $7,900 worth of credit that you get to reduce your tax payable by. However, the government is a little tricky here. If your income is over $39,000, they'll start to reduce that credit and completely wipe it out if your income in retirement or after the age of 65 is over 92,000. So they say, yeah, you deserve a break because you're a little bit older, the seniors discount. But if you're making too much money, then we don't think you deserve that discount. So you're going to pay full rate. Pension credit, $2,000 of pension income, in essence, is tax-free because there's an offsetting credit for that. But again, all of those are non-refundable credits. If you don't owe any tax, they're not going to send you a check. A couple of the most common refundable tax credits are the climate action incentive, which they removed from the tax return. They took a marketing 101 course and realized that they give you this, whether you owe any tax or not, you get the climate action incentive. But when it was done on your tax return, they thought, oh, people don't even know that we're sending them money. So they took it off the tax return. They're paying it quarterly. They did it so quickly in this last year that they missed out on the first part of the year. So you would have gotten a check for 2 quarters in July. You would have just received your October quarter, and you'll get another one early in January for 2022. And so although it's costing them a lot more money, the intent is to have you think, gee, isn't the government wonderful? They're sending me money every 3 months. So that's what I call marketing 101 from CRA. The HST is another refundable credit, whether you owe any income tax or not. If you qualify for an HST credit, they're still going to pay it out to you. Yeah.
Great.
So
why don't we walk through an example now, Derek?
Okay, so we've got Carrie. She gets a tax credit, not a tax deduction, but a tax credit of $1,000. The lowest federal rate, combined federal and Ontario, is 20.05%. Her income tax was 100, or her income was 125,000. Her tax payable was $33,789, but she gets a $200 tax credit. She doesn't save the $434 that she saved with the deduction. She only gets $200, so she gets a tax refund of 30, or tax due $33,589, being equivalent to that $200 tax credit. Now, Brian, he's moaning the fact that he's not making nearly as much as Carrie, but he gets the same $1,000 tax credit. This time he's a lot happier because his marginal and the lowest tax rate are exactly the same. So he still gets the same $200 tax credit benefit that Carrie did. So again, this is leveling the playing field. Doesn't matter how much money you make, the credit is equally applicable across all income bands. So now let's go back to one of those other lines you were talking about, Chelsea, the net income versus taxable income.
Well, before we get there, I'm actually going to touch base on charitable donations.
Oh,
While we're in tax credits, I figured we might as well talk about this one. So
very good.
the reason why we're bringing this one out is because it's very unique. It doesn't work like all the other ones. On the first $200 that you make or that you donate to a charity, you get a 15% credit, just like all the other donation or all the other tax credits. However, once you cross over that $200 line, you actually get a 29% credit on any donations you make. And then to add even more to that, if your income is over $200,000, you get a 33% credit for some of your donation. Now, the government doesn't want to give out too much of a credit, so they've actually limited how much of a credit you can get to 75% of your net income that could be claimed as donations. So if you do ever make over this amount, you would actually be able to carry it forward to future years. So you could use it for, say, next year's tax return. And also, if the taxpayer passes away that tax year, they can claim 100% of their net income. So it's not, if you were to pass away, your donations wouldn't be limited to the 75%. You would be able to claim up to 100% of your net income. Now let's get to net income versus taxable income, Derek.
Just one thing I'll mention, those tax brackets we mentioned were the federal tax brackets, and each province does match the charitable contributions, so you would get that credit from the provincial government as well.
Great.
And it's a great tax planning move for those people that may have a large estate burden because of unappreciated or appreciated rental properties, cottages, those kind of things. Making a charitable donation out of your will can often reduce or eliminate the income tax owing to the estate, and make things a lot clearer for your heirs. So yes, let's get back to talking about net income versus taxable income. You'll say, what's the difference? Well, net income is often used to determine your eligibility for certain benefits. Taxable income is used to calculate your taxable income. So some income, such as workers' compensation, is considered a part of your net income, but it's not taxable. So if you have workers' compensation, or in my mother's case, Dad was a POW in the Second World War, so he was receiving a veteran's pension for being a prisoner of war. When he passed away, there's a survivor pension. That pension is like workman's comp. It's not taxable. It gets included in the net income, but there's a deduction line below it, which takes it out, so you don't have to pay income tax on it. However, what it does, as I mentioned with the age credit at age 65, if you're receiving some of those kinds of incomes, that could claw back some of the some of the age credit. And for example, those people that are age 65 and over that are receiving old age security, there is a clawback there if your net income is above $81,000 in 2022. They will start clawing back some of your old age security. And if you get up to about $129,000, you would have your entire old age security clawed back. Now, we sort of have a joke here that we're trying to get all of our clients to not qualify for any old age security. And people are a little shocked when we say that, they think they should get it. And I say, well, if you can't get by as a couple on $250,000 a year of income, then we have a whole different problem. But we do try and minimize that OAS clawback for everybody that we can. And it's based on net income, not taxable income. Okay, did I miss anything, Chelsea?
Oh, I think you covered everything there. So we'll be moving on to investment income now. So not all forms of investment income are taxed the same. So we'll be walking through the differences. So looking at this picture, we're going to be moving from right to left. So what types of investment income are taxed the highest versus the lowest? So we'll start with interest income. So 100% of interest income you received is taxed at the same rate as your employment income. So if we're looking at this chart, 100% of interest income, which means it's the highest and you're paying most of the taxes, so it falls into the right bucket. Then we get to dividend income, which is a little bit more complicated as there's various different forms of dividend income. So here are the few of the most common ones. We start with eligible dividends, which are mostly paid from Canadian companies that are publicly traded. Now, these dividends are grossed up by 38%, but then they also have an offsetting federal and provincial dividend tax credit. So if you're invested in mutual funds, you'll see dividend income on your tax return, but then later down below in your credit section, you'll actually see a dividend tax credit. There are also non-eligible dividends, which are paid from private Canadian companies using income tax at the small business rate. So personal income and business income is taxed differently. For example, if you own your own business and you take dividends out as income instead of salary, these would be considered non-eligible dividends. Business income of less than $500,000 is also taxed at a lower rate thanks to the small business deductions. Now, non-eligible dividends are also grossed up, but by a smaller amount, only 15%, and they also are offsetted with a smaller tax credit. To finish off the dividend income section, there are also foreign dividends, which are paid from companies outside of Canada. They have no special tax treatment and they are fully taxable as income. So that's the dividend income section. Now we'll move on to another form of investment income, capital gains. So as we're moving along with this picture, we are moving more to the left and paying less tax. So capital gains are only 50% taxable. So that means if you have a $1,000 capital gain, it only results in $500 of taxable income. Lastly, we have return of capital. So these distributions are tax-free. There is no tax when you withdraw your own capital, so your own money that you put in from an investment, as you have already paid tax on it. There are some investments like real estate trusts that are allowed to treat a portion of their distributions as return of capital, thereby minimizing your taxable income. One caution though, once you use up all of your cost base, any remaining funds are unrealized capital gains. So when you then withdraw those, they are taxable as capital gains. Now that is a lot of information. So let's throw all that into an example. Derek, can you walk us through Brian as an example?
Yeah, I will. Just one thing I'll mention on that is that dividends, how they get grossed up. So if you receive some income, which we'll show in a minute, actually, let's show that and I'll relate it back. So
okay,
this is an example of Brian with $50,000. So in all cases, he ends up with $50,000 in his bank account. If he got $50,000 from his employer, $50,000 of interest or foreign dividends, foreign dividends, because there's no break on that. Eligible dividends, he actually reports on his taxable or his net income, taxable income, $69,000, even though he only received $50,000. So this is where it can get a little bit precarious for people over the age of 65, even though there's a tax credit and you pay less income tax, if you've got a lot of dividends and other pension or other type of income after the age of 65, that gross up means that your old age security will get clawed back that much sooner. So dividends, on the one hand, while they might be great, they cause you a lot of extra problems once you get over 65 if you're close to that old age security clawback. Non-eligible dividends, you would report 57,500. Capital gains, you would only report 25,000, and return of capital, you report nothing. Yet you've received the same $50,000 in your pocket. So what do the taxes do? Well, we saw from the example that Brian owed $7,511 of income tax from his employment income. The interest in foreign dividends, if it's all interest, it's basically going to be the same thing. If it's foreign dividends, he'll actually end up paying a little bit more because there were some foreign taxes paid that he gets no credit for. And there's no exemption, or there's no CPP credit, EI credit, and that kind of thing. So that's why the income tax due on interest in foreign dividends is a little higher than if it was straight from employment income. Eligible dividends. Now, this is if that's the only source of income you had, $50,000 of dividend income, no CPP, no old age security, no nothing else. You'd only pay $600 of tax on that, which is incredible. But if you had $2,000 worth of employment income, then your taxes would go up higher than that. Non-eligible dividends, same kind of thing. You're paying more than the eligible dividends, but a lot less than interest or foreign dividends. And capital gains, again, because you only report half of the gain, your tax is reduced significantly. And return of capital is the best. Unfortunately, not every investment is treated as a return of capital. You would pay no tax on that. Have I missed anything, Chelsea?
No, that was good. I think you put all those words into one little chart here, so that was very helpful. So next, we are going to walk through the 4 Ds of tax planning. So those are deduct, divide, defer, diminish. Tax planning strategies generally fall under these 4 categories. So you can deduct taxes, defer taxes, you can divide taxes between 2 or more parties, and you can diminish your taxes. So let's start with tax deductions. Like we talked about earlier, deductions reduce your taxable income. So here are a few examples. Strategically contributing to your RSPs is a great example of how to use tax deductions. There's another strategy called debt swaps. So this entails using your taxable investments to pay off a debt, for example, a line of credit, and then re-borrowing on your line of credit the same amount to invest back into your portfolio. The interest on your debt is now tax deductible against your investment income. It's a very interesting strategy. Another one is maximizing rental expenses. If you are renting out a portion or an entire rental property, any expenses incurred to operate the rental can be deducted against the rental income. Now, there are certain rules on what you can deduct and can't, so speak to a tax professional if you're unsure about any of those expenses. Another deduction is childcare expenses. Now, you can't deduct everything, so you can't deduct if you're putting your child in hockey or soccer or things like that, but you can deduct any costs related to daycare or even day or overnight camps in sports schools that are the main purpose is to look after your child. So those are a few examples of tax deductions. Now let's move on to tax dividing strategies.
So income splitting. I tried to get a slide here with like a Dairy Queen treats a pizza, although I don't divide that, I take it all myself. So this is something I'd be willing to share. I'm not so big on the sparkles. But the whole idea is if you have one taxpayer earning $100,000 and the spouse earning 0, they're going to pay a lot more tax as a family than if we could get that closer to $50,000 each. Now in the US, they have one tax return that both husband and wife complete per household, but we're not there. There's lots of things that are going on in the States that don't apply here. So we're looking at different ways that we can divide the income or split the income to get us into a lower tax bracket. So for those that have retired and have a company pension, GM, teacher, whatever, as long as it's a company pension, you can split up to 50% of that income with your spouse, no questions asked. Doesn't matter what age. If you took an early retirement at age 55 and your spouse isn't working, you can take 50% of your pension, move it over into their category. So if you had a $60,000 pension and the other spouse had nothing, boom, you now have two $30,000 incomes. And as you saw from that, you know that they're now both in the bottom tax bracket, both paying the least amount of taxes. Joint ownership on account. So if you have an investment account and you're earning investment income, whether it be interest, dividends, or capital gains, having a joint account allows you to split it. Typically, it's split 50-50 if it's husband-wife, although it can be split any different way. The only caution here is that you can't be changing it from one year to the next and say, oh, spouse didn't work that much this year, let's claim 100% in that spouse. Oh, now they're working a lot and I'm not working as much, I'll claim it this year. You're going to get in some trouble with CRA if you keep moving it back and forth that way. So again, jointly registered accounts are typically the best for splitting tax purposes. However, there might be a case. So an example, let's say you've got some high-flying executive, you've got Carrie, the example we use, she's making $125,000. Her husband is a stay-at-home dad. He makes nothing. So what you are, he's not quite stay-at-home, he's making $20,000 a year. So what you could do in this case is you could allocate all the expenses to Carrie. She would claim all the, she'd say, I'm paying the mortgage, I'm such a good husband, I even pay his income tax, or a good wife, I pay his income tax for him, I pay for his CPP, I refund him that, so he's got the whole $20,000. He can now invest that. So if he invested that in his own name, he would pay tax on all the interest, the dividends, capital gains, and because he's in a much lower tax bracket, there would be less tax paid. That's not often the case, but sometimes that's the case. Another one would be prescribed rate loans. This is mainly people that own corporations, or again, where one spouse has a huge income or maybe has come into an inheritance and has quite a bit of money in their name. They can loan money to their spouse at a prescribed rate, and that's set by CRA, which was very low until recently. It's now going up. And what happens is, for example, you could lend $100,000 to your spouse at the prescribed rate, and let's just use 3% for right now, because it'll likely be that soon if it isn't already with the latest increase. So what that means is, at the end of the year, your spouse has to pay you $3,000 worth of interest. You have to declare that on your income. But if they bought a GIC or earned $5,000 worth of interest income or taxable income, they get to pay the tax on that. So it's a little bit more complex and convoluted, but it's something for people that have large amounts of non-registered money that's taxable. It's a way to shift money to a lower tax bracket. You can also gift money to adult children, or you can gift money to friends and family. You could gift money to us, and then you don't earn anything on it, so you don't have to pay tax on it. Of course, it's not your money anymore, so that's a whole different problem. So you want to be careful about that. But oftentimes, we have people that, once they get into the retirement years, we make sure they've got enough for themselves. But if there's excess, they may want to help out their children or grandchildren, especially with the way prices of houses have been in the last few years, and they gift that money to them as an early inheritance. That takes the money out of their hands, and they're no longer taxed on it. But again, it's no longer your money. If you have a business, you can hire a family to work in the business. However, the government has really tightened up those rules. You couldn't pay your spouse or your 12-year-old kid $150,000 a year for coming in once a week to take the garbage out. It has to be something that's reasonable, and you would likely hire somebody else for that job if they weren't doing it. And one of the few things you can do is you can gift, or you can make contributions to your spouse's RRSP or TFSA out of your funds. Again, governments are fairly good on this between spouses. However, you cannot contribute to a child's RRSP or child's TFSA. You would have to give them the money and they have to make the contribution themselves. So that's some different income splitting strategies, and I think I've covered them all.
Yes, wonderful. Thank you, Derek. So the third D is deferring. So you can defer receiving taxable income until a later date when you're in a lower tax bracket. So as I mentioned earlier, RSPs provide a tax deduction for contributions, and it allows you to defer the tax on those funds until you withdraw them. So typically when you make an RSP contribution, you're earning, substantial income. Typically we recommend not making an RSP contribution unless your income is over 50,000. And then at a later date, you would start withdrawing from your RSPs once your income has dropped lower than what you were earning before. So typically under $50,000 is when you would start withdrawing from your RSPs. A more complex strategy is a vendor take-back mortgage. So this allows you to spread out the realization of capital gains from selling an investment property over multiple years. So to give an example, we've used this strategy with many of our clients who are looking to sell their cottage to their children, so they're still able to use it, but the name has moved over to their children. However, the capital gains still need to be realized. However, with a vendor take-back mortgage, say there's a $100,000 capital gain on the cottage. With this strategy, you would be able to spread the gain out at $20,000 over the next 5 years versus claiming a lump sum of $100,000. 50% of it would be taxable because remember, only 50% of capital gains are taxable. But this would likely push them into the highest tax bracket, but definitely higher. Now, Derek, can you walk us through the last D, which is diminishing?
All right, diminishing. So one of our goals is to try and have your tax returns stay pretty level all through your life, and even your final return. People are always concerned about, oh, there's going to be a huge tax bill when I pass away. And in some cases that's unavoidable. But our goal is to try and keep you as level as possible all the way through that. And so there's a few ways that we can do that. So maximizing your tax advantage investment accounts to reduce the amount of taxable income you receive. So as we talked about, especially if you're into something that pays high dividends and you've got a registered account, like a tax-free savings account, or a non-registered, a taxable account, and you're over 65, we would certainly want to try and move most of those dividends into the TFSA as opposed to the open account, because you're going to be taxed on those dividends that could cause you old age security clawback. We try and keep as much as possible capital gains in the open account for two reasons. One, only 50% of the capital gain is reportable, and it's only reportable when you actually cash something in. Now, if you have mutual funds, they do capital gains distributions because the fund managers are selling off some stocks at a profit, and you're getting your share of that. It shows up on a T-slip at the end of the year. But capital gains are much more in your control. You can decide if you want to trigger a capital gain or a capital loss. This might be one of those years where we're doing quite a bit of that as we look forward, because fund managers at the beginning of the year, when markets were high, they were selling off companies that they had a good profit on, made large distributions into your portfolios, which if it's in a non-registered account is going to show up in a T-slip as a taxable capital gain. Of course, since late January, early February, the market has gone pretty much down and people are looking, why am I going to owe tax on a portfolio that I'm losing money on? And that's because they've realized that portion at the early part of the year. So we can do we can do a switch. We can crystallize the capital loss and use that to offset the capital gain that is otherwise being reported. You can also carry a capital loss back up to 3 years. So we have some clients in a situation where they're coming to us where they'd paid capital gains in the last 2 or 3 years, but now they're in a loss position. So we can trigger that loss. We can file what's called a T1 adjustment, or their accountant can. We can't, we're not accountants, but their accountant can, or they can do it themselves, and they can get a refund on the capital gains that they paid in previous years, because now they've got these capital losses to carry back. There are also, similar to the return of capital type of investments, where there are a few of those. There are some investments that are considered corporate class mutual funds. And what they are is they're literally the same mutual funds, but instead of being set up as a trust where a trust flows all the interest, dividends, capital gains through to you, they're set up as a corporation with different classes of shares. And as you may or may not be aware, a corporation cannot pay interest. They can only pay dividends or you receive capital gains. So these corporate class shares, what they do is they convert any interest income or foreign dividends into Canadian dividends or capital gains. Now, there's typically a higher management fee for the benefit of that, and we have to see if there's a large enough benefit for yourself, but that is a type of share that's available in some mutual fund companies. Not all companies, but some of them do have that. If you're incorporated, you can choose, as Chelsea mentioned earlier, to take dividends, which is beneficial in one sense that you pay a lot less tax, or you can take a salary. The disadvantage of taking the dividends out is that you have no salary, which means you have no contribution to CPP, which means when you get to 65 or 60, whenever you decide to take CPP, they'll say, oh, you never contributed, you get nothing. So the tax benefit is great on taking dividends versus salary, but if you don't invest some additional money, that money that would have gone into CPP, you could end up spending most of your money and not having enough put away for retirement. So you have to be very careful in that. Donating to charity, as we talked about before, can significantly diminish your taxable income, or the tax payable, I should say. If you donate shares in kind, so literally you say you've got some shares of Bell Canada that you've had since 1995 and they've appreciated a whole bunch. If you sell them and gift the money to the charity, you're gonna have to pay tax on the capital gains. But if you literally pick up that share certificate and give it to the charity, then legally we don't have to report any of the capital gains. So there's a legal way of avoiding capital gains tax. And Chelsea's going to walk us through an example of how that would look.
Yes, awesome. Okay, so we'll look at an example to illustrate the benefit of in-kind donations. So we have Bill here. He makes $250,000. If he were to sell his $1,000 from his mutual fund to make a cash donation, the cost base of this fund now is $50,000. So he would have a taxable capital gain on top of his $250,000 salary, and he would end up paying tax on that gain at the highest marginal tax rate. Now he would still get a tax savings from a donation of about $35,400, but there could be a better way of doing this. So instead, Bill here is still earning $250,000. Now, if we were to donate $100,000 in kind from his non-registered investments, he would have no capital gain, and he would actually have a net savings of $47,700. This is an additional savings of $12,000 just by utilizing this strategy. In-kind donations can be especially beneficial in situations where you need to cash an investment with a large unrealized capital gain, and donating a portion in kind can actually leave you with more in your pocket even after the donation. So I hope that's pretty clear. If you need to make a donation and you have capital gains in your portfolio, this is definitely a strategy you should look into. Now, Derek, why don't you finish us off with our personalized year-end tax optimization process?
Right. And we realize that not everybody has $100,000 in a charitable bequest in any given year, but the same principle applies whether it's $10,000 or $1,000. And we've helped many clients with smaller in-kind contributions. The charity benefits, they pay less tax, and oftentimes the people end up donating a little bit more. And the only one that misses out on that is CRA, which we haven't had too many tears shed over that loss. So our year-end tax optimization process, and some of you have been through this before, but we review last year's tax returns. We estimate what kind of income from investments, and if you've got variable income, we estimate what that will be, any kind of deductions that you might have. And we cheat a little bit. We're not tax professionals, we're not accountants, but we have a copy of same kind of software that they use. So we feed the information in and make up like a mock tax return for you. So we've been fairly accurate with that. We then review your financial plan and your goals, how much cash you might need in the next couple of years. Do you have enough access to it in tax efficient, like in your tax-free savings accounts or in your open account? Then we identify what we call the optimal level of taxable income required. And so that basically means if you're in the lowest tax bracket, we'll try and bring you up to the top end of the lowest tax bracket, take money out of your RIF or RSP a little bit at a time, just so that you're not going above that 20%. We analyze tax liabilities, potential sources of taxable income in the future. In some cases, if you've got an accountant, we'll confer with them to confirm things. We finalize our projections and then make a recommendation. And one of the most common ones, again, if somebody's in a low tax bracket, we'll take out a little bit of money out of their RSPs. Now, that might be just for a year, they're taking a year off, or they've been laid off, take money out. When they get back to work, we can take that money that they've taken out and only pay 20% tax on, put it back in, and they can get a 40% refund on the same money. So we might look at, if you're not in the retired stage, you're making extra income from other sources, we might look at increasing your RSP contributions, triggering capital losses, as we mentioned, and those kind of things. So did I miss anything, Chelsea? Those are sort of the main things.
Yeah, no, that was great. So now some people might be thinking now, why would I pay more tax now versus spreading it out? So one of the major reasons is by taking money out of your RSPs and RIFs and adding the net proceeds to tax sheltered accounts like a TFSA or an open account even, this gives you a bigger pool of tax efficient income to draw from for larger expenses instead of being forced to make large taxable withdrawals. The goal of this is also to reduce your lifetime tax bill. So by taking little bits out of your RSPs and RIFs along the way, it substantially decreases the amount that will be left in there upon you passing. And 100% of that you have to pay tax on eventually. So Derek's going to walk us through an example here of something we've actually done with a client of ours and show you how much tax we've been able to save.
Okay, so this particular client, they were both in the early 90s. He passed away, and we were working on the strategy before, but he passed away in talking with the surviving spouse and the children. We said, we can just take the minimum RIF out, and that's what we would expect without optimizing. Yeah, they'd only pay $11,800 worth of tax over the next 3 or 4 years, which was sort of the life expectancy. But the estate would end up owing $31,000 plus because of the amount left in the RIF. So what we did was we paid a little bit more now, bringing them up to that, just that ideal, or what we call the optimal tax level. They ended up paying $32,000 in total, but there was nothing left in the RIF. The RIF has now been exhausted. Everything's in the tax-free savings account, so that'll pass through to the heirs with no tax, no probate. And basically, we've saved them $10,000 over a period of 3 years, just by paying a little more now instead of waiting for later. So again, those are things that we look at. We look at not just individual years, but how things go over the longer term. So Chelsea, wrap us up with what can we do before the end of the year? Yes.
Before I get there, I just want to send a reminder, if any questions have come to your mind, feel free to pop them in the chat function on Zoom. Should be one of the bars across the bottom, because shortly after this, we're going to be getting to the question side, so you can start getting those ready. Okay, so some considerations before year end. So all of these must be transacted before the end of the year, except for RSPs. They are the only exclusion that has to be done by December 31st. And for this year, the deadline for RSPs is March 1st of next year. So going through a few of these, in order to reduce your taxes, you can make a charitable donation, which of course provides you with a tax credit, which we've already talked about. This can be very helpful to reduce your tax payable. As Derek mentioned, you could also look into triggering capital losses to offset any capital gains. So also, as Derek said, some people might actually have capital gains to report this year due to, the markets were up at the beginning. So if you did make any trades at the beginning, you would have capital gains, and you can actually trigger capital losses now to offset those gains. Another thing that you could consider is triggering a gain this year. If your income is low, you could actually trigger some gains now to help bring your income up to the top of the lowest tax bracket. If you are expecting to need some money from your TFSA within the next, 3 to 6 months, we suggest you take it out before December 31st, because by the time January 1st comes around, whatever you withdrew in this calendar year, you can recontribute next year. Another thing, as I mentioned, RSP contributions deadline is March 1st. So if your income is, higher than 50,000, we typically recommend making an RSP contribution. Of course, talks with your financial professional to get some advice on that, but getting those in before March 1st, as well as maximizing your TFSA. So the annual limit for this year is 6,000. However, the lifetime limit is 81,500. So if you have any money sitting in a non-registered account with still room in your TFSA, get that in there. Now, those are just a few. There's a lot more. So obviously speak with your financial advisor. But we wanted to just bring those to your attention as, to put on your to-do list before December 31st.
So a couple things I'll add in. One, make a charitable donation, especially if it's over $200, because remember the credits on over $200 is the equivalent of having a tax deduction at a $90,000 or $100,000 salary or income, because you get the tax credit at a higher level. And so even if you're in a low income bracket, donating money will give you a bigger tax saving on that. Another one, if you haven't already done your traveling around Ontario for this year, run around like mad, spend $1,000 each on accommodations on Ontario for the Ontario staycation tax credit. I don't know if it'll be in next year, but they have a special one-time staycation tax credit. You have to check because it's not for golfing, it's for staying in accommodations. You can check the rules out, but you're allowed to get 20% back on up to $1,000 per person, or $2,000 expenses per family. So you could end up with $400 extra back in tax savings if you've been spending time in hotels or resorts or anything like that in Ontario during 2022. And you've still got 2 months, so spend $1,000 in November, $1,000 in December, and it's only going to cost you $1,600 because you get $400 back. There you go.
Great, awesome. Yes, so we have come to the end of the presentation. So we have reached our question and answer section. So feel free to put your questions in the chat function and we can list those off. Now we do have one. It says, do you expect the tax-free savings account limit to increase next year?
Yes, I didn't do it, but I did read an article of somebody that's I think he's probably got the heart of an actuary, but he's been following along the tax-free savings limits. And we use the numbers for CPI, Consumer Price Index, at the end of September every year. He's been going through and he says, based on what inflation has been this past year, when it gets reported very shortly for the end of September 2022, says that should move us up to the $6,500 for next year. And the interesting thing is that because we're now moving at a rate of inflation, and as the number gets larger and larger, they move up in $500 increments. So we're likely to move up and start to get that every couple of years, that extra $500 increment, because 2% inflation on 5,000 is only $100, but 2% on 7,500 is $150. And so you only need a couple of years to get close to that $500 increment and move you up.
Awesome.
But while we're waiting for other questions, if you know people that just like paying tax as much as you do, feel free to pass along our phone number or email, or do an e-introduction to us. Say, hey, Derek, here's my friend Jimmy. He hates paying taxes as much as I do. Give him a call.
Another question came in. They're asking, what type of investment income do GICs provide? So I can answer this one.
Okay.
So GICs, it's 100% interest income. So if this is sitting in a non-registered account, this is fully taxable on your tax rate. Now, One strategy that we have started to use is actually hiding GICs in tax-free savings accounts, because GIC rates are what, 4.75, even 5%. Now with the additional bump in the interest rate of 0.5% this morning, we expect GIC rates to increase with that. So you can actually tax shelter that interest income inside your tax-free savings account. But yes, it is 100% interest income, which is the highest. Keep your questions coming. We do have about 5 minutes. So again, you just put it in the chat function and it gets sent directly to me.
And as you might be aware, with Chelsea reading the compliance requirements that we had to read out at the beginning, we will be posting a replay of this. We've been recording it. We'll post it to our website. We have to send it up to compliance for them to listen and make sure that we said all the right things. And once we get that approval, which usually takes 3 or 4 days, we'll get it posted to the website. And again, if you only saw part of this, or a few people who came in a little bit late, you can go back and see the thing in its entirety. Or if you have friends that say, oh, I'm interested in that, you don't even have to see us. They can go inobtrusively and on our website and watch the whole thing, and we'll never know.
So another question came in. So this will be our last question, as we are nearing about 12:30. So we want to keep to our time. But this person has clearly been reading up on the news articles, because they're asking, what is this new home buyers tax-free savings account I keep hearing about?
Okay. First, let's go. The first home savings account. It's sort of a cross between the existing first-time home buyers plan and a tax-free savings account. You can contribute up to a maximum of $40,000 with a maximum of $8,000 per year. So you could fully fund it over 5 years. It does not affect your RRSP, your regular RRSP contribution. You can build up to $40,000. Again, only $8,000 a year. So here's an idea for, if you've got younger people that are wanting to start out towards the home path, child or grandchild that maybe doesn't have a home, you could gift them $8,000 a year over the next 5 years to put into this first home savings account.
Yeah. And
it grows tax-free. And as long as it's withdrawn to purchase a house, it's taken out tax-free. No taxes owing, they don't have to repay it. If they don't buy a house, they will be able to transfer it into their regular RRSP account. And so therefore defer taxes. Again, if we can't diminish taxes, we can defer them. So that money can continue to grow tax-free until such time as they retire or draw it out, because they've got great tax planners like ourselves.
Great. Thanks, Derek.
Great.
Yes.
Anything else? Last call.
Last call. We will be sending out a link for you to view this video, as Derek mentioned. You'll have our contact information from that. So if you do have any other questions that pop up in your head after this, which we do find happens often, especially for me, feel free to send us an email or give us a call.
And we thank you for taking the time out of a gorgeous day to sit in front of a screen and watch us and the exciting world of taxes. So we'll talk to you again soon, and have a great rest of October and into the end of the year. Bye for now.
Thank you all.